Oil prices are set to fall again, with Saudi Arabia expected to force through a deal to increase output later today. Australia's election surprise suggests incumbent governments are safer than they used to be. ANZ Research trims its Australian GDP forecast, and Indonesian GDP data later today is expected to show a softening. That's coming up in our 5 Things in 5 Minutes on Monday, May the 5th. And then in our bonus deep dive interview, ANZ Senior Commodities strategist Daniel Hynes is highlighting the need for metals markets to prepare for strategic reserve building in the wake of China's ban on rare earth exports.
As Trump introduced these reciprocal tariffs, it wasn't surprising to see China announce constraints on exports of some of these rare earths.
But first, in 5 and 5 with ANZ, oil prices are set to fall even further below $60 a barrel, with Saudi Arabia expected to secure another 2.2 million barrels of production a day by November at an OPEC Plus meeting later today. West Texas Intermediate futures closed down 1.6% at $58.29 on Friday night, ahead of that meeting today. And Reuters is reporting sources saying overnight that Saudi Arabia had secured agreement to increase production, in part to punish overproduction by Iraq and Kazakhstan. Here's ANZ Senior Commodities strategist Daniel Hynes speaking late on Friday about Saudi Arabia's approach.
They have certainly come out and said that they're willing to withstand low prices for a sustained period of time. And I think that's probably the only way to really force the hand of some of these overproducing nations within this production group. So if we do see a further acceleration in those production hikes, we could certainly see oil prices under further downward pressure with that potential influx of supply hitting the market just when there's many questions about the economic backdrop and what it means for demand.
The Nasdaq and S&P 500 closed up 1.5% over the weekend on hopes China is more amenable to a trade deal with the US to lower tariffs. But US Treasury prices fell, pushing up the US 10-year yield by 9 basis points to 4.3% and the 2-year yield up 13 basis points to 3.82%. The US dollar index fell 0.2%, while the Aussie dollar will start this morning at 64.44 US cents. That's up 0.9%, and it's yet to react to the election result yesterday. The Kiwi starts up 0.7% at 59.48 US cents, and gold begins at $3,257 US an ounce, up 0.7% from Friday morning. Number 2. One reason for the rise in Treasury yields is growing expectations the Fed will hold firm in the face of calls by Donald Trump for rate cuts. The FOMC decides on the Fed funds rate this Thursday morning, Sydney-Melbourne time. ANZ Head of FX Research, Marjabeen Zaman, expects the Fed to hold.
So far, Fed speakers have broadly been a little bit weighed towards the hawkish side, because jobs data is one thing, but inflation has been holding up. We continue to expect the Fed to sit tight as the tariff uncertainty continues to unfold over the next week and thereafter.
Number 3. In Australia, the incumbent Labor federal government was re-elected on Saturday night with a surprise landslide that increased its control of the lower house of parliament. ANZ Group chief economist Richard Yetzinger says it's unlikely to move markets much because the tariffs remain the main focus. But the result is remarkable, with PM Anthony Albanese being the first to be re-elected in 20 years.
Secondly, coupled with the size of the Labor Party's majority, for a long time, I think a lot of people who get paid by the word have been saying, I wish the government had a longer perspective. I wish they took a decent horizon look at the economy to come up with some decent reform, which lasted the length of the strait. Australia's got its first chance in a couple of decades for that to happen. That's great news.
Richard says the result in Australia is also notable in a global context.
Every election globally has gone against the incumbent for about the last year and a half. Here we have an election that not only has gone in favour of an incumbent, but resoundingly so. Not obvious this necessarily translates everywhere, but at least watch this space. It's potentially a very interesting shift if it carries over elsewhere.
Number 4. ANZ Research has trimmed its GDP forecast for Australia in 2025 from 2.4% to 2.0% and for 2026 to 2.2% from 2.6%. ANZ Head of Australian Economics, Adam Boyton, says a softening of consumer confidence was the first factor.
And then on the business investment side, our thinking is that there is just more uncertainty in the environment at the moment. That will cause some businesses to delay some investment plans. And it's those things together that see that little downgrade in GDP growth from 2.4% previously to 2% at the moment for growth this year. What we expect next year is that the additional monetary policy easing in our forecast will help lift growth back up to around that 2.25%.
Number 5. Indonesia's GDP data is due today and is expected to show a slowdown in the first quarter to an annual rate of growth of 4.8% from 5% in the December quarter. ANZ's chief economist for Southeast Asia and India, Sanjay Mathur, explains the softness.
One, domestic income growth has slowed down, and households are also keen to rebuild their savings. The additional problem that's come about is that the current administration has been sort of recalibrating its government expenditures, and as a consequence, spending has sort of come to a halt in the first 2 or 3 months of the year, and that will show up in the GDP data as well.
Sanjay Mathur there. Now, in our bonus deep dive interview, ANZ's Senior Commodities strategist Daniel Hynes says metals markets, like oil markets, now need to think a lot more about countries buying metals for strategic reserves, in part to catch up with China, who's been doing it for many years.
Now that geopolitical backdrop is becoming quite fraught, and certainly the involvement of critical minerals in the energy transition means that it's a sector which I think government's becoming increasingly focused on. And certainly Trump has put that pretty high on his agenda, looking to boost access and supply of critical minerals, considering that China is dominant in this sector. And if we do get a full-blown trade war, that's one of the levers that China can pull, restricting access to it. So I think governments are going to become quite sensitive to securing the supply, because it not only will help develop that energy transition that many are going through, it's critical to sectors like defence, which obviously is becoming much more of a focus in recent times.
Could you give us a sense of the sorts of restrictions on exports that we've already seen, particularly out of China, on the area of rare earths, or as Donald Trump called it, raw earths?
Yes, well, they've certainly utilised their trump card there. Sorry for the pun, but the country, China, dominates the downstream processing of rare earths in particular. And this is quite a common phenomenon across the broader sort of metals complex. But they can essentially stop the exports of these materials, which can have a massive impact on other countries like the US. And certainly as Trump introduced these reciprocal tariffs, it wasn't surprising to see China announce constraints on exports of some of these rare earths, which do go unnoticed but are critical for a reason. They feed into a lot of sectors such as defence, aerospace and the like, which a lot of countries obviously are quite sensitive to. And this is something which will certainly force the US government to stand up and take notice, because there's really no other sources where it can get its supply of these minerals at the moment.
And who's best at doing the strategic stockpiling so far?
Well, I think countries which are the dominant sort of producers of the raw materials themselves are certainly in the best position. And you look at traditional mining countries like Australia, Canada, South Africa, those types of historic sort of producers of metals are certainly in the box seat. But it will be the countries that are able to build up a downstream supply chain, which can obviously then process these ores into the metals that are required into these sectors. And that's going to be a difficult challenge, certainly something which China has been doing for some time and has quite a high level of experience in it now. It will take a lot of effort, a lot of money for other countries to build up that supply chain to the same extent.
So how much demand are we talking here? How much do the other countries have to do to catch up and to get their inventories to a level that would be enough? Because it's a debate too about how much is enough.
Yeah, absolutely. And I think initially you would certainly want to have enough to sustain a temporary disruption to supply. And you can take examples from the energy sector where the IEA recommends having 90 days of supply as stockpiles. Yeah, that's probably something which I think countries should consider on the critical minerals side. But really, if you want to build up a much bigger sort of source of supply to feed that industry over the longer term, you may need to push that level up to maybe a year's worth of consumption. Certainly, when we look at China, it does appear that they have built up stockpiles quite aggressively over the past 5 to 10 years, to the order, in some cases, of a year's supply of output.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, May the 5th. Catch you tomorrow with a deep dive into Indian equities valuations with Sanjay Mathur. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.